Good afternoon, everyone. It's good to see you all again. And even though I can't actually see you, hopefully you can see me. Hope things are going well for you. We had, I had planned on doing this about 2 weeks ago, 2.5 weeks ago, and I ended up getting a sinus infection and a cold that went into my chest. And I had laryngitis, had almost no voice for 2 to 3 weeks. And when you're a minister like I am, amongst other things, I kind of talk for a living, it put me down for the count. We had a fair number of people in the office that got COVID. Shelby did, Tess did, my granddaughter Darcy, that I want to talk about in just a moment, and a fair number of other people. And so, at any rate, I'm a little bit later doing this than I wanted to do it, but had some things I wanted to go over with you guys just to bring you up to speed on where we are and where our thinking is and what our plans are. First off, let me say that many of you, you call in, you're going to hear a new voice in the office, and that voice would be my granddaughter, Darcy. Most of you know Shelby and Tess or know who they are, my son and daughter-in-law. They have one daughter. Her name is Darcy. She's 21 years old, and the love of her life is horses, and she has about a dozen quarter horses, but she learned pretty quickly at age 21 that she couldn't make a living doing that. And so she's joined us. So now we have 3 generations of my family as part of this firm. And I'm very thankful for that. So if you happen to pick the phone up and Darcy answers it, we'll tell her who you are and a little bit about where you come from and so forth. And she'll get to know you better. I built this firm 25 years ago, basically about 24, 25 years ago, on the concept of old-fashioned service. When I was a kid, and I'll be 69 in a couple of months, you knew people in the grocery store and the bank and the drugstore, and they knew you and they knew your parents and they knew all about every aspect of your life. That's precisely how I built this business. That's why some of you work with Kim, some work with Tess, some work with Sequoia, some work with Holly, and in time, some of you will be working with Darcy. We have about 850 families that we take care of, and I don't want any one of my assistants to have to take care of more than a certain number of households. So at any rate, that's kind of where she came from. Sequoia is 3 years younger than me, so she's 69. She's gone from working 4 days a week to 3 days a week. And I'm going to be happy to have her work with us as long as she chooses to. And then we will say goodbye to her, and Darcy will largely take over that. So now down to business. We have had a crazy 2022 pretty much across the board. We have seen a total sell-off of everything. I've been in the business 30 years. I have been doing buying and selling stocks and bonds for about 40 years on my own before getting in this business. And I've only seen this twice before. And that was in 2001 and 02, and what we would call the dot-com bust and the bubble and bust. And then 2008 and 9, which was the housing bust, where you had Bear Stearns and Lehman Brothers go under and so forth. To give you an example, and I'll be showing you data in just a moment, of the 500 stocks that make up the S&P 500, that's the 500 largest companies in America. Only 2 of them are positive, 2% rather, 2% or about 5 of those firms are positive now. That's as of about Thursday or Friday. So there's a couple of things happening that is relatively short term. There are other things that are going to be much more structural or long term that we're going to have to deal with. To start with, the Federal Reserve, Jerome Powell and company, have lost almost all credibility with the market. Now, I will tell you the bond market is tremendously larger than the stock market, and there are reasons for that. Maybe we'll talk about in time. The Fed chairman, as well as Janet Yellen, the Treasury Secretary, have been wrong on almost everything that they've said. Some people would say they've been wrong on everything that they've said. So fundamentally what's happening, and I think it's a good thing, is the bond market and the stock market are fixing things on their own. They're not waiting for the government. The story that I hear over and over, was in meetings all day last Wednesday with a firm that we have a lot of money with, and you all have money with. Tomorrow morning, Jeremy Werner and I are headed to Palm Beach, Florida, where we're going to be in 3 days of meetings out there. And what I see happening basically is the market's going to fix itself because they simply have no confidence that anybody in our administration knows how we got here, and they certainly don't believe that they know how to fix it. But the markets will fix themselves, and they're doing that, and you'll see that coming up very quickly. When the 30-year mortgage goes from 3.5% to 6 to 6.5% in 90 days time, and the Federal Reserve has only raised rates twice, but yet that has doubled. That's because the market is fixing itself. What's the purpose of raising rates? To slow down the economy. We pumped in around $7 trillion in assets into the economy in a time where people were not working, businesses were shut down. All of a sudden it opened up. After COVID, things began opening up and people were buying and selling like there's no tomorrow. And because of that, we have all kinds of structural issues, supply chain issues, everything from making of cars to making of refrigerators to getting ships into ports. That was largely coming into Los Angeles and Long Beach Harbor because they had so many problems in California. These ships are now coming through the Panama Canal and coming to Houston and Savannah, Georgia, and Fort Lauderdale, Florida, and even the East Coast of the United States. So those problems are being fixed, I can just tell you. So what I want to do is I want to go over with you some of the things that we've talked about before, and this is something that you have seen. If you were to look at your allocations, you would see that. This is as of today, this morning. So you take a look here for just a moment and you see year to date where we are. So what's happening to stocks? What causes everything to sell off? It doesn't matter if it's the industrial stocks. You can see here the S&P 500 is down 22%. The NASDAQ, the S&P is split into two groups. Half of that, 250 stocks, are growth stocks. Half of them, or 250, are value stocks. That largely is determined by dividends. Do companies pay dividends? If they pay a 2 or 3 or 6% dividend, they're considered a value stock. Taking a look at this, what you see is nothing has been left. And this is happening for a number of reasons. People that manage your money have backed away from the table. But fundamentally, this is what's happening to all of this. Because the Federal Reserve has lost credibility largely, and because companies do not know what the future is, they're struggling mightily to determine what their earnings will be in 3 months, 6 months, and 9 months. Stock prices are determined largely by how much profit did a company make today, and what do they plan on making in 3 months, 6 months, and 9 months. When companies don't know exactly what the Federal Reserve is going to do and don't know what things may be done to fix the supply chain, they're struggling greatly. I would tell you something that caused this last sell-off was when Target and Walmart, just two companies, came in and announced what they believed their earnings would be in 3 months. And within 3 weeks, they came in and had to reduce those numbers again. That sent some shockwaves through the system. So companies are trying to figure out, what does the future look like in the next 3 months and 6 months? And consequently, what will their earnings be? When they determine that, then the markets will begin to line out. If we were to go a little bit further down here, this is another way of showing the same thing. The S&P 500 is divided into all of these different sectors, and not a single one of them has made it through. Utilities are about the most conservative They pay a huge dividend, and you can see they're down 9%. There is no sector that has not been hit. Part of this is margin calls from companies that had margined, all kinds of things. This is what I've talked to you about before that is of concern to me. Many of you have been with me a long time, even 20, 25 years. And we talk about that stocks move opposite bonds about 70 to 75% of the time. Well, this is not one of those 70 to 75% of the time. This is because the market, the bond market, is raising rates so fast that you see these numbers down. Your bonds, in many cases, many of you look at your account and you're down 15% or 17%, and you say, oh, it's the stock market, get me out of the stock market. Well, two things are happening. First off, our bond portfolios, which are about the safest investment in this nation, are getting hit. And secondly, they are our ballast. In most cases, when the stock market starts getting hit, we get a little concerned, our clients do, and we move to bonds, which causes bonds to move opposite stocks. That is certainly not happening at this point in time, and I will tell you why. If I owned a bond and that bond paid a 4% dividend and my bond's worth $100, paying 4%, but you could go over here and buy another bond paying 5%, then my bond's not worth 4%. So fundamentally what's happening is rates are moving up so fast, it's taking the bond market a while to correct. From our perspective, the challenge is that largely is our ballast. It's why if the market's down 20%, most of you would be down 8 to 10, maybe 12 in a little more aggressive portfolio. But because the bond market, as you can see here, and we use a lot of US corporate investment grade bonds, sometimes we use tax-free bonds, and you can see all of them are down almost as much as the stock market is down. So that is kind of where we are on that. I want to talk about something that I showed you some time ago. This was a number that we were looking at. If you look at the right of my screen, that number was 4170. What you saw was the market sold off. If we were to go back here a ways, and it got to this point, and I talked with you at the time that it touched that point, went back up, it came back and touched it again. We had a nice relief rally that went up 10%. We came back, and what happens is we hit exactly that spot again. Now we've gone from the early part of March to now the end of April, as you can see. And you see the market hitting here and here and here, a little pop up. And then we've had this sell-off. And it went below that number. And I said to you, if it stayed below that number for some period of time, we would begin making changes. Now, what you see happen is basically this. Here is that number, 4158. So we had a sizable sell-off. This was in part several things, but one of which is Target and Walmart, as I mentioned, basically came out with reduced earnings numbers, and within 2 to 3 weeks reduced their numbers again. So that sent some fear in the markets because these are two massive, very stable companies. We had basically a bottom here. We had an update going into a long weekend, which is a very good indication. If people were concerned about really negative numbers, we would have seen a big sell-off on Friday, because having Saturday, Sunday, and the market being closed yesterday for Juneteenth, there's all kinds of news that could have come out that would have created a problem. So the fact that we were a little bit up on Friday is a good number. Tuesday, we're up nicely today. I expect us to come somewhere back into this number. The other thing I said to you in our last conversation was, if inflation is going to be significant for multiple years, 2-3 years, something in that range, even 12 months, that we would be coming out of bonds and moving into real estate. Real estate being a hard asset. Just like if you own a house or you own land, that will go up in value when because of inflation. there's every indication, although we will not be 8% or 9%, and I don't think we've topped yet. I think we will be a little higher, but there's every indication that 4% inflation is going to be around for the next 2 to 3 years. So what we do with real estate is basically it gives us a good 5%, somewhere in the 4.5% to 6% monthly dividend rate, but it also appreciates because of what the companies are doing when they make their facilities better or one thing or another, plus inflation. So that's something that we're going to be doing. I'm looking for the market to come back up into this 4,100 range that we've talked about in the next little bit. And when that happens, we're going to be moving about 20%, maybe as much as 25% of our bond type funds to cash. And in time, we will be visiting with you about real estate. Most of the real estate that we do has an expected 10 to 12 or up to 15% annual return. And about a third to half of that comes from a dividend that is kicked out every month. These things require a little bit more paperwork and several signatures on your part because they're not daily traded, they're monthly traded. So you can get out of them every 30 days, but it reduces a lot of this day-to-day volatility. And the simple fact is, I'm looking for a way to make sure that we are back at flush or above, hopefully within the next 6 months, but certainly within the 12 months. In addition to that, part of what I'm going to look at is something that's relatively new to our world, but has been in our industry for a decade, called structured notes. And we will be talking more about those. Those are basically buying options, puts and call options on your investment. So if it goes down, we make money. And if it goes up, we make money. Some of them, we just put a floor underneath them where you cannot lose more than 1% or 2% or 5%. So those are called structured notes, and I'm learning more about those. And it's just one of these things that's new to people like me at my level in the investment world. We're very excited about that. In addition to that, pardon me, let me say to you that 40% of all of our assets are in annuities. The reason why they're in annuities is because times like this really have no impact on those of you that have them. If we have something that automatically in a worst case steps up at 5 or 6% a year, then and basically gives you a lifetime payout, we can calculate based on that number what is the least amount that you will receive in income. So sell-offs like this are just incidental events. And as long as you stay within that annuity, then it has no impact on our planning for your retirement and so forth. Some of you, we will be having more conversation about that going forward. At any rate, we've got, that's a lot, and it's a little bit longer than I expected on talking with you. But I would say to you that we have begun basically doing reviews recently, and I'm looking forward to seeing many of you again in the relatively near future. If you have any questions, be sure and call us. And the thing from First Trust that I showed you a little while ago, we will be emailing to each one of you, and it has good information on the right-hand side as well. So I'm going to sign off with that. If you have any questions, be sure and call one of us. Look forward to seeing you face to face before long, and take care of yourself, and God bless.